Good evening, David Phelps here. Good to have you on. We'll be starting in just a few minutes. While we're waiting to get started, I love to use the chat to curate questions from any of you who have questions as we go along. What I'd love to know right now is just maybe jump in, make sure the chat's working. Let's use the chat versus the Q&A, right? So let's go to the chat. It's more on the left side of the bottom of your screen. And just jump into that chat. And if you just type a hello and where you're from, just so I can get an idea where people are coming from. I've got a few other questions I'll ask as we go along, but I love to have back and forth. So if you would do me the favor, if you can, just engage a little bit and just give me thank you. Thank you, Nora. Very good. San Diego, excellent. All right, William, appreciate it. Fort Worth, just across the Metroplex from me. Michael from, I got to open my chat. Sorry, missed it. Michael, thank you. Yeah, keep going. I love, okay, here we go. From Moscow, Idaho, great. Okay, North Carolina, very good. Oh, Steve, hey, Steve, good to, well, not to see you, but to hear from you. I know exactly who you are, Steve. All right, very good. Let's see, we've got Sam. Now it's going fast. Good. Sam from Florida, Peter from Kentucky, Rob Las Cruces, very good. Nick out of Houston, Adam from Philly suburbs, Sharon from Dallas, very good, Sharon. We're in the same neighborhood almost, I would say. David from Wisconsin, Dave from Pennsylvania. Thank you all for engaging. Seriously, if you'll use the chat tonight, I won't necessarily try to read and give my short presentation at the same time, but I'm going to try to keep my presentation relatively tight tonight, just because I love to answer questions. So feel free to use the chat as we go along and just type stuff in there, because Alex, who is on my team, will help me curate those questions. And I'm going to try to keep the whole presentation to under an hour tonight, and I'll take questions thereafter. So we might go a little over an hour. I'll stay really as long as people have questions. I love some back and forth. So again, I'm not going to try to bore you with a whole bunch of data or a boring presentation. I just want to do this so that people have a chance to think a little bit about where you are in the market cycle, what you're doing with your practice, exit, capital deployment, things that I think about every day. We're about a minute away from the top of the hour, so I'll give another minute or so before we actually jump in. But thank you all for jumping in and engaging. Let's see. Brian from Indiana, very good. Lori from Houston, super. All right, you all great. The more you engage and type questions in as we go, the more I will be thrilled to answer to the best I can. Here's a question from William already. Have we seen the top of the market for private equity? Very good. We're gonna get into that. Yes, sir. Very good. Great question. So we'll definitely dig into that. Yeah, keep them coming. Keep them coming as we go through tonight. All right, we're top of the hour. I'm going to go ahead and get started. Can we go over current multiples? Yeah, to the extent I can, I will. All right, so let me just give a little bit of my quick background for you all. As disclosure and disclaimer, I am not a practice broker. I'm not a transition specialist. I am not affiliated with any DSO or any kind of a group practice. I don't give tax, legal, or business advice. All right, I'm not licensed to give any of those things. I give education. I give opinion. I try to give opinion based as much as I can on facts, but we all have opinions, right? So I'm going to give you my very biased opinion about things, and you can take it for what it's worth, right? Everybody's got their own opinions in the space. You might also ask, why do I do what I do? Why am I doing this web class? I don't have anything to sell you. Nothing to sell. I am going to provide resources, because that's a big part of what I love to do is give guidance where I can and recommend resources and other places you can go. You may know that I founded some 13 years ago a community called Freedom Founders. It is really the joy of my life. I will give you a very short shrift on how I got into that and why I do it. I'm not here to sell you into Freedom Founders. There are some of you that are probably here because you'd like to hear about it. I'm not going to sell you on it. There's an opportunity to have a call with Alex or someone on my team to see if there's a fit, but there's no pressure. There's no selling. I just do what I do because I love to do it. When I started in, before I started in dental school, when I was in college, I was trying to figure out how I could be a good steward of money I would someday have. Not that I'd really earned any real money, just odd jobs trying to get through school, waiting tables, but still thinking ahead, knowing that I was going to go into dentistry at some point. But I started reading books on stock market and real estate while I was in college, and real estate just made a lot of sense to me. So I talked my dad who lived a couple states away from me, talked him into being my financial partner, and we co-ventured on the first rental property. I've got a picture of it. In fact, I should just probably jump into the slides right now before I get too carried away here. So let me just do that. Give me a second. Let me close my chat here, and thought I had it closed here so I can see better what I'm doing. Close the chat. Let me power up the presentation here, and I'll show you a few pictures. All right, I think we're good there. Let me start the slideshow there, and boom. Okay, good. All right, so we're talking about the DSO bubble tonight, which we'll go into multiples. We'll go into where's private equity, a couple of the questions that already came through the pipeline, but I'm giving you my really short background. All right, so this is me graduating from Baylor College of Dentistry. Now, not Baylor, it's now Texas A&M, but when I graduated in '83, it was Baylor College of Dentistry in Dallas, Texas. One of my best friends on the left, as you look at the picture. I never had facial hair in my life, so it's not me on the left, but that's me on the right. Yeah, exactly 40 years ago, almost to the month, a little bit afterward. All right, this is the house. I say this is the house. I never lived in this house. This was my first investment property in real estate. It looks like a pretty grand house. It wasn't that way when we bought it, my dad and I. It was structurally a very sound house, and we just really basically followed the rules that I knew about real estate at that time. Location, location, location. Find the worst house in a good neighborhood. So really basic stuff, right? We bought this house in 1980. So I was in my freshman year, D1 in dental school. Knowing I was going to be there for 4 more years, I said, Dad, let's buy a property because I've learned about this stuff, and I think it makes sense. Even though I still lived in an apartment, I rented this property out, learned how to manage, I learned how to deal with contractors, learned about managing tenants, and I also learned that assets produce a lot of growth in equity and also cash flow. I made more equity on this property, my capital gain profit, which I split with my father when we sold it when I graduated dental school in June of '83. We split about $50,000 in long-term capital gain profit. My 25-ish was a lot more, or it was probably a lot more than I made waiting tables nights and weekends, and certainly the return on my time was probably at least a 10x. So that's where I really figured out the light bulbs went off, that there's something about tangible assets, and I set forth to go into dentistry, build my productivity and efficiency and clinical management in dentistry. But at the same time, I also was working really hard in real estate. There are some other people in our space, young docs, that are doing the same thing. It's not easy to do. My wife and I didn't have children until 9 years later. I've actually been out of school 9 years, so there was an opportunity to do both. I don't recommend that people with families necessarily try to do both, because it can suck a lot of your time. So I put a lot of time in on the front end, both in dentistry and in real estate. But what it afforded me to do is in a timeline really set me free when I need to be free. So let's flip on through that. It's my daughter, Jenna. This is Jenna in 1995. She would have been about 2.5 years old. This was about 3 weeks later. She doesn't have bumps on the left-hand side, but you can tell she's losing her hair on the right. She has high-risk leukemia. She's being treated with steroids and chemo and the whole 9 yards for the next 3 years. She went through this horrific treatment. She survived it. Let's see, this would be, so when she survived it by age, call it 5.5, had epileptic seizures for the next several years that were uncontrolled. And by age 12, which is the picture here, she's back in the hospital undergoing a liver transplant. She was in end-stage liver failure. So her first 18 years of life were pretty tough. And that's where I came to the decision that I needed to make a change in my life, because I was focused on really trying to keep the practice going to be financially secure for my family. But at the same time, it's like I needed my time to go be with my daughter. And so I made the not a tough decision, but certainly a strong decision to sell my practice at that time. That was 2004. And I knew I could always go back to dentistry. The key thing is I had enough in assets that I could buy time to be with my daughter. I could always go back to dentistry. I did not, because I had more space, margin, a chance to really see what I wanted to do next, and something we do a lot in Freedom Founders. All right, let's get into the topic here tonight. I got to give you a little bit on the economy, just from my perspective. I'm not a doom and gloomer. I'm not a fear monger. I just am a realist. You can hear everything from one end of the pendulum to the other in terms of where we are in the economy. but I see a lot of headwinds. We've had massive stimulus going back to the 2008 great financial crisis. We've had that quadrupled coming out of COVID, which has imparted or imputed the greatest amount of inflation we've seen since going back to the 80s. When my dad and I bought that first property, by the way, our mortgage interest on that property was 13.5%. So you think 7.5 or 8's high today? Well, we were at 13.5, but everything equilibrates eventually, and I think that's one thing that I want you to be aware of, that this higher for longer rates that the Fed Chairman Powell and the Federal Reserve are promoting, because they're trying to fight inflation. So they're not going to go as high as they went in 80. They can't. We have too much debt. But just keep them as high as they are right now will cause an equilibration or a reset, a downset in equities across the board. All equities, stock market equities, in real estate equities, and dental practice or business equities. It's just it's a natural law. It's an economic law. It's just, there's a lag effect. There's a lag effect. So you say, well, where is it, David? When's it coming? Trust me, it's coming. Rising taxes because the federal government spends like drunken sailors. These historic asset bubbles, which we'll talk about in all assets and equities. And of course, the elephant in the room is the massive debt. We went into 2008 great financial crisis with about $8 trillion in public debt, and today we're over 33 trillion, 4 times in just 14, 15 years. Massive debt, which is in my opinion the game changer, where we can't just go back and casually reset, and Fed Powell can't just lower interest rates back when he feels like it. There's some real problems ahead. Of course, you have to figure out who do you believe. You've heard the Fed and Powell talk about everything under the sun, and typically have to backtrack. But of course, inflation was transitory, a year and a half ago. We know that it's not. Even the Wall Street Journal has come out, and this is not recent, like in the last few weeks, but this is within the last couple of months, how they're talking about, well, we're going to, the government, the economy is going to stick the soft landing that the Federal Reserve talks about. Another one from Wall Street Journal, the markets appear convinced the Fed can pull off a soft landing. And I think the markets in general do think that. There's a lot of complacency. There's a lot of this time's different. We've had this rapid rise in interest rates, and hey, so far the markets are doing well. Yeah, but there's a lot of things breaking behind us. 40 years of inflation and interest rates. You can see by this graph. We look at the peak of inflation in 1980, which as high as it was, and you also see the federal funds rate also to bring it back down. And we've seen 40 years now of interest rates from the peak in 1980 coming all the way down to the bottom in the summer of 2020. And where are they? What are they doing now? Well, they're headed back up again. Not as high as they did in 80, but it doesn't matter, because it's the rate of change that matters. When you go from 0 to 5.5% on the Fed's fund rate, that's a massive change. So it's rate of change that matters. Back when Volcker was fighting inflation back in the late 70s and 80s, interest rates were already around 7.5%, 8%, 9%, and he just took them to 20. So it's relative. The change is relative. Couldn't do that today with the massive amount of debt we have. There's no way, but they'll still have to fight inflation the best they can. Of course, the stimulus, the Federal Reserve, there's prints money because we have the reserve currency, and they see there's no consequences. There will be consequences. That's what causes the asset bubbles. Figuratively speaking, like money's been running uphill, and everybody who's been in any kind of the asset equity markets in the last 14 years has done very, very well. And a lot of people think, well, it's because we're so smart, we're so good at what we do, we're just great investors. Look, I've been through a number of market cycles, and it's not because I'm some great investor that I made money. I've been disciplined. I've learned when to hedge. I haven't always been perfect in that, but I am also very, very concerned about what I see in the marketplace. And I'll talk a little bit before I end this short presentation about where I'm hedging and where we're hedging in Freedom Founders. Obviously, we can see the interest rate change from 1980 at the peak all the way down to the bottom in 2022, and then again back up again. The inflation rate, again, we see the great run up over the last, since really started picking up in August of 20, and you can see it really spiking up in 21 and all the way up to a high by the government's Bureau of Labor Statistics. A high of like 9.1% was last year, and it has been decreasing. But here's the thing to keep in mind: The government manipulates all the data. If you use the same CPI metrics that were used back in 1980 when inflation was running as high as it was up in the teens, today's inflation rate, which I think they last call, depending on which index you look at, is down to in the fours. It's really not in the fours if you use the metrics of the yesteryear. That's really about 11%. So the government lies about the data because they want to calm the markets. So just remember, when the government puts out data, you've got to look at that with a skewed look. You can't always believe everything. In fact, I believe very little of what the government puts out today. You just got to get your own stats. I always say you can't solve a debt crisis with more debt. Yet that's exactly what we're doing, pretending like we can spend like and have credit cards and no one has to pay them back. Eventually, they have to be paid back. Here's the total public debt ratio to GDP. You can see here we are sitting over 120%. That's like crossing the Rubicon. The only way to turn that back without monetizing the debt, that is creating more inflation, is by austerity programs. We'd have to cut the federal spending by about 40%. Not going to happen. No politician can ever run on that. So the real answer is we're going to go through a deflationary period, which we're heading into right now. We'll talk about that. And then on the back end, I foresee much more inflation, probably going to some level of hyperinflation going through the rest of this decade. And who knows where it's going to go. I'm not very optimistic about our government ever getting things under control. We've already had breakage in the marketplace. Just go back, 6 months ago, the spring of this year, we had SVB, Signature Bank, what was the other one? First Republic, Credit Suisse. These were the initial breakings. Now, everybody came out, the Federal Reserve, Biden, oh, it's all good. It's all under wraps. It's all good. It's all good. And I would tell you it is not. In fact, it's worse than it was. And the next onslaught, whatever triggers it, I think could be very, very difficult. Real estate, which I love. I enjoy real estate. I've been focused on real estate for over 40 years. But a crash is coming, particularly in commercial. Housing is also going to see a correction. I just don't believe as dramatic as commercial, but it will. It will. I love this quote from Bob Dylan, "The Times Are Changing," the album that he wrote. I think that was published in 60. Sorry, someone else here probably knows. 68. He says, "Then you better start swimming or you'll sink like a stone, for the times they are changing." And ladies and gentlemen, they are changing. So here's the first position on the DSOs. And what I want to bring to the forefront is your equity, the equity that you have built up in your respective practice or practices. Wherever you are in that pathway in running your operations, your business, wherever you sit in that, at some point, you're going to look at possible exit or transition. Some of you are probably here tonight because you're in the middle of them. Some of you may be on the back side, and maybe you sold to a DSO and you're in the final earnout phase. Some of you might be right at the front door and looking at some LOIs right now and considering that. And some of you may be somewhere down the road and you're just say, I just want to see what's going on here so I can kind of like try to anticipate what I might need to do. I've got a question I want to pose. There it is. And these are anonymous. So when you answer them, it's all anonymous. We don't know who's answering what, but I'm going to launch this. Here's my question to you. Have you sold your practice? What describes your situation here? Have you sold your practice? You're considering practice transition options, or you're in the middle of soliciting LOIs. Those are the three options. So if you just take a quick look at those, I'd just like to get an idea where people are here in terms of your practice situation. Have you sold it? Are you considering it? Or are you actually in the middle of getting some LOIs? So I'll give it a few more seconds here, and then we'll see where people are at. All right, very good. I'm going to go ahead and end the poll. I'll share it with you, and looks like the results are very strong on considering. So a lot of you are here, 82% are considering possibly transitioning your practice, equity, harvesting some equity, selling it all, do it DSO. A few of you are here, you sold, and some of you, again, a small number, are right in the middle of soliciting LOIs. All right, thanks for that. That just gives me a little bit of clarity on where people are. take that out. And sorry, I just lost my screen. Hang on, folks. Sorry, too many controls here. Maybe I must have killed the share. All right, let's go back. All right, there we go. All right, so this one's public. North American Dental Group. Many of you have probably read about this one, but this is one where the dentists involved with North American, I can talk about this because it is public, are in a class action lawsuit because of let's just call it, malfeasance in the way things have been handled. This situation where it's not going to be, I'm not going to say it's broad based. It's going to have in every DSO. Of course, I can't say that and I have no dog in this hunt. As I said, I'm not affiliated with DSOs. I don't do practice brokerage or transitions. I don't think DSOs are good or bad. It's just like anything in life. You have to be very clear about what you're doing. There are some very wise people. I think there are some good brokers, and I'm not going to give names here, but if anybody wants resources, again, I have no claim. I don't get referral fees from people, but I'm happy on the side if you want to email us after this and ask for resources. We'll provide some additional resources, but I'm just here to help. But I think you've really got to know who you're dealing with, and I'm going to give a little bit of context on what I know. Again, it's going to be high level. Some of you probably already know this, but for some of you who are considering it, I think it's very, very important you understand the ramifications of what you need to look for before you, quote, partner up or consider any kind of equity transition, particularly when you're looking at group situations. This is Mark Rowan. He's the CEO of Apollo, a large hedge fund, very large hedge fund. And this just came out last month. I've got the full article here, and I'm not going to read the whole thing to you, but Mark Rowan, private equity, what they do is, you understand, it's leveraged buyouts. They don't have their own money. They are using they borrow money. They borrow money just like in real estate. Commercial real estate operators oftentimes borrow short-term money, variable rate, to get into a deal and then get it stabilized. Well, private equity, the whole game is, for the majority, again, there's exceptions, but the majority, we'll get to a slide here, but they're really aggregators. They build their momentum and make their profits on turning through leverage. The problem is, with the higher interest rates we're having right now, it's changing the entire game. I know this because I deal in real estate, and the debt situation and interest rates is the same thing across the board in the economy. Private equity doesn't have some magical place where they can go print money like the Federal Reserve. They have to deal like everybody else with the rising interest rates. And again, this huge rise in rates is changing the model. We'll get to who not by name, but what I think you need to look for if you're going to do business with a DSO, a private equity-based group. Basically, Mark Rowan says, a decade of money printing, fiscal stimulus, and low interest rates that pulled forward economic demand is in retreat. They are essentially moving. This is the whole article here out of Financial Times. You can look it up, read the article. Essentially, they are moving from equities, which is the leveraged buyouts that have been so predominant, particularly in the last 14 years. But this goes all the way back to the 80s, ladies and gentlemen, where they were called corporate raiders. They changed the name to leveraged buyouts because it sounds nicer. This is Steve Schwartzman, the CEO of Blackstone. Again, a large private equity, same thing. They're moving to private credit, meaning lending money versus going to equities. They're pulling out of equities. Why are they doing it? That's the smart money. They're seeing that the growth phase, the opportunity to use the cheap debt is over, and they're changing the model. So that should be a clue to anybody. If you're going to get in bed with somebody who's used a model that's worked in the past, how do you know it's going to work in the future? I know the same thing in real estate. I'm moving away from equities, have been moving away from equities for the last year. I am also doing private credit. So I'm bringing you these things in tandem because they're in the same, they fit in the same box as what you're having to look for if you're dealing with the potential exit of your practice. So here's the aggregation. These are aggregators. You can see the numbers. We're Heartland, the big dog at the top, Aspen Dental, Pacific Dental Services, Smile Brands, MB2, Affordable Care, Dental Care Alliances, Great Expressions, Western Dental. By the way, I can name some other ones. I think I had some notes here. If I can put my hands, I know Great Expressions has had problems. There's a couple others not necessarily on this list, but have had some problems. And sorry, oh, I know, I stuck it somewhere else. Sorry, I've got papers, but I know Great Expressions has had problems. There's others that have problems that I know anecdotally, but I can't really name them. All right, so according to the American Dental Association, almost a third of dental grads say they plan to join a DSO, right? So they have a model that works well because the kids are coming out of school with a lot of debt. Many of them don't really want to own practices. We've got more female graduates who think in terms of more flexibility in families. So the DS model has utilized all these factors in the economy, plus the cheap interest rates, their ability to use leveraged buyouts to make this model that has taken a lot of steam in the last, call it maybe 5 or 6 years. But that steam is running out. That's what I want you to be cautious about. I'm not saying that a DSO buyout is not something you shouldn't look at. I think you should look at them, but I want you to have clarity. Here's the percent of dentists affiliated by age with DSOs, and obviously it's in the younger crowd, right? We just talked about affiliated with DSO doesn't mean you've sold to a DSO. It just means that you've got some affiliation with, and obviously the older population, like me, not so inclined because, well, you probably don't have to. It's probably kind of late in the game, but earlier in life, these are the options that have been presented, and for some people, they've been good. For some sellers, it's been good, and for some younger docs, it's been good. But you know the stories. I don't have to tell you. It's not all what it appears to be on the outside necessarily. So let's talk about operators versus aggregators. I'd say the bulk of private equity are aggregators. There are good operators. But you've got to determine the difference. Who's an aggregator? Who's an operator? Aggregators focus on the rollout. They talk about the fast turn of the money. It's what they're about. The quality operators have experience running, and usually geographically, and they have especially diverse operations with degrees of complexity. So you've got to figure out with your due diligence who you're dealing with. Those that are turning fast and trying to create these fast recaps, particularly in the marketplace now, I wouldn't bet the farm on a fast recap. Same thing in real estate. Syndicators who have been making money hand over fist over the last 5, 6, 7, 8 years with their fast turn of their equities, all that's going to get pushed out. Strong operators will make it through. They're just not going to have the recaps, the refis like they've been used to in the previous years. Same thing in both markets. You've got to just understand that. And even though a lot of them still promise, oh, we're thinking we're going to recap in the next 12 months, they don't know. They don't know is the key thing. And if I were to bet, I would say that likely they will not, because they have to borrow the money just like everybody else does. Where are they going to get the money? So what are the key drivers for DSO success in 2 frameworks? First one is operational efficiency. Are they truly good operators? Do they really understand dentistry in this case? Or are these financial people, bean counters who just like to run the numbers? And secondly, as big is the underlying debt structure. Do you know what the underlying debt structure is? I've talked to some very, very good, prominent practice brokers, transition specialists, and when I ask them, how deep do you go when you do your due diligence? They go, well, we ask for financials, but they're hard to get. And I'm thinking, personally, I wouldn't do business with, partner up with anybody, this partner up thing, with anybody where I can't look at their balance sheet. What are they hiding? I don't do real estate deals with anybody who doesn't show me their financials. If they don't show me their financials, I'm done. I'm out. It's like, what are you hiding? So if you can't get those, I don't know if I'd be doing business with somebody. So where does their financing come from? We call it the parent financing. Where does the current funding come from? What are the terms? What's their debt look like? What's their terms? And where's this money going to come from for the future recap? Where's it going? They can't promise it. The markets are tightening up right now. Banks are in a crisis. Liquidity is contracting. All of this run up in equities, whether it's real estate or DSOs, has all been built on cheap capital and tons of liquidity in the marketplace. That's reversing 180 degrees right now. The times they are changing. Remember too, that there's a big difference between a sale, a practice sale, and a buyout. When you sell something, an asset, you get a check and you're done. That's usually what we've known in years previous when most of the sales were done to private buyers. You had a private buyer, another dentist would come buy your practice, they go to the bank, get financing, you got a check, you're done. Maybe you stayed on to help out with the transition, but basically there's no earnout. A buyout is just that. It's a leveraged buyout. You get so much up front and the rest is an earnout based on when they can recap and the numbers that go forward. That's where the problem is. My basic mantra to people today is, if you're going to do a deal with the DSO, be happy with what you get on the front end. If you're happy with what you get on the front end with no egregious clawbacks, you're good with that, and you feel good about everything else that's there, then go with it. If you're counting on these recaps, be very careful, because again, no one can promise you're going to get those. We put together a checklist, which we're happy to provide, and we probably will provide as an update. I think Alex we're planning on sending some additional resources out after this webinar. If you registered, we've got your email. We're not here to try to sign you up for something, but we're going to send you resources. We'll send you the entire checklist, but here's a few pieces from the checklist. Number one, be sure you get a third-party quality of earnings assessment on your practice. There's different iterations of EBITDA. You don't want to let the DSO be the ones to tell you what your profit margins are. You need to have somebody else look at it, and now you've got some negotiating power. So that's tip number one. I said already, you need to ask for the DSO's balance sheet and P&Ls. If they won't give them to you up to date, I don't mean from the end of year of 2022, if they can't give them up to you at least up to the last quarter, there's something wrong, okay? In the purchase and sales agreement, make sure the accounting used now will be the same accounting used in the future, cash versus accrual. Changes in accounting method can make earnouts disappear. I have someone in our group, Freedom Founders, who sold, and they changed the accounting from cash to accrual, and their earnout went from what they were promised down to like nothing. You've got to understand what's in the fine print. Private equity is very smart money, and they have very talented lawyers who write their paperwork. If you don't have equal representation on your side, then you're potentially walking into a quagmire. Don't let that happen. Make sure that the rights of termination are clear. Beware of giving them the right to fire you from your own practice. Again, you've got to look at that. Be very, very clear about what that looks like and what rights they would have to do that. Make sure you have at least debt voting rights. You're a minority partner in these deals. Recognize that. You've got no controls whatsoever. You better have debt voting rights so you can control how much more debt they stack on to your practice and other practices. If you don't control that, they can do just like the federal government. They can stack debt up and they can walk out. And this has been, I'm not saying that's big time in dentistry, but that's the way private equity has worked in going back to the 80s. That's how they do it. You can read the stories. They have taken down hospitals. They've taken down nursing homes. They have basically gone in and stripped out the assets, putting debt on, and they escape. They've got paperwork that lets them off the hook. You've got no recourse. Good luck. Be very careful. Clawbacks. Make sure that whatever you get on the front end isn't subject to some egregious clawbacks where if you don't make certain numbers, et cetera, et cetera. Remember, you had no guarantees when you went into practice. No one guaranteed you that having a license and going to set up a practice or buy a practice that you were going to get a certain amount. Well, then doggone it, don't let them talk you into agreeing to certain numbers. If you do, again, I think you're selling yourself short. Don't get sucked in that. Last thing is a put option. Put option is where you own the option to sell the remainder shares or equity in your practice by a certain time for a certain price. Now, that can come with a little bit of a cost. You might need to give up a little bit of your front end equity, but I would definitely put a put option in. Why? Because they can string you out for essentially indefinitely on the recap. They can string you out. You better put a stop in there somewhere. Again, if you have good representation, they can help you negotiate this. Don't just give up the ship when you're negotiating with DSOs. You've got to stand up to it if you're going to do it at all. Lastly, deal fatigue. Good negotiators know how to do this, whether it's DSOs in dentistry or in real estate. You get the seller, enticed, you get the LOI going, you start showing them the big check they're going to get, and then you start wearing them down. If some of you have gone through that, you know exactly what I'm talking about. They will wear you down, and right at that time, you're just dog tired. They throw one more thing in, and you just surrender and go, okay, I've already kind of mentally spent the money. I told my wife and my family, and the practice sales going through, and you're there, and they've just got you at the finish line, and they suck you in one more time. Be very, very careful about deal fatigue. Happens in really all markets. You've got to be careful about good negotiators who will pull that on you. All right, second part of my presentation. Again, I told you I was going to keep this tight. Just checking the time. All right, let's say that you have exited, or you think you're going to get to an exit. All right, the benefit is you've got capital. You've got those chips off the table that you wanted. You've got that equity. You've harvested it. You pay tax on it, and now you've got to do something with it, right? Because up until now, that equity is something you built in your practice. You created it. You enhanced it. It grew over time, and it operated well because you had your hands in the mix. You were the operator, the owner-operator. You're done with owner-operating. That's why you're selling. It's like you've done that, been there, done that. Great. Now you got to take that capital and do what? You've got to make it work. It's not going to work as hard for you as you did when you had it on your hands, but it's your job to be a good steward. The question is, where do you go? Where do you put it? If you're paying any attention to the economy and some of the things I show at the front end, I would be very, very scared of any equities, real estate or financial equities. If you're still there, again, I'm not giving you financial advice. I'm just saying beware. I would go to higher ground. I'll talk to you about where I see higher ground today. Again, this is my opinion, my experience. You've got to take this and just go back to your advisors and ask them questions about what might be right for you. I'm not telling you what to do, but here's how I look at it. So I got one more question. This is the last question I'm going to ask. And if you just go with me on this one, let's see. Here we go. All right. I want to know what you think about the current market. So here's my question. The current market, number one, do you have concerns? You have concerns about the stability of the financial markets? That's Wall Street. You're not sure how you should invest your capital. Number three, you'd like to diversify in alternative investments like real estate, but you don't know how. Which one of those best describes you? Just so I kind of know as we talk through the last part of this presentation, I can try to make this as relevant to you as I can. So I'll give it about 5 more seconds if you'd like to cast a vote there. Looks like it's fairly even, which is fine. That's great. I'll share the results with you. You can see overall, relatively even across the board. Concerns about the stability of the financial markets. Not sure where you should invest your capital, and you would like to diversify, but not sure how to do it. All right, let me get rid of that. I'm not sure how to get rid of that screen. That's what I did before I killed screen sharing. Oh, there's got to be a way to do it. Let's see. I'm not smart enough. Maybe it's there. All right, I can make this work. Maybe I can move this out of my way. All right, let's talk about equity versus debt. So we already talked a little bit about how people use debt. Private equity uses debt to acquire assets. Well, that's typically what we do when we're investing in any kind of asset. Your dental practice, for one, right? Or if you have a commercial building, or you've invested in some real estate, or you've done some syndications during times where there's growth and relatively low cost of capital, low interest rates. That's where debt comes into play. It's a great model. That's where growth comes from. But there's times in the market, like we're in right now, where we're getting ready to roll over. Roll over meaning we're going to go from equity plays, the big growth that we've had over the last 14 years, into what I would consider very low growth, very stagnant growth. That's what Schwartzman of Blackstone and Mark Rowan of Apollo are saying. The equity plays have run their course. They're moving. This is big money. This is smart money. They're making some big moves here and rolling over into credit, the debt side. Debt as an asset, not as a liability. We think about debt as borrowing money, but you can own debt like a bank and you can lend it. That's private credit. And in the real estate markets, you can play on both sides. Sometimes it makes sense to do some of both. It's kind of like a stock bond portfolio, right? Stocks are your growth, but you want to kind of mitigate risk by putting some money in bonds. It's kind of the same thing in real estate. Although the returns we can get in real estate, whether it's equities or debt, are much higher. But it comes with a cost. You know what that cost is? It's an inefficient market. You've got to be connected. You got to do some due diligence. You got to get in there and be a player somehow in the game, but your returns can be much better, more sustainable, more predictable. Again, I've got 4 decades of experience to back it up. I just know that to a fact. It's not risk-free. Nothing's risk-free. But to continue to abdicate financial responsibility to Wall Street, I think is going to be a big problem for those who put most of their emphasis there in the next few years. What we've known in the past is not going to continue forward. The models are changing. The times are changing. These are just some pictures of Blueprint Days. Blueprint Days are the new members who come to Freedom Founders. We do a small group, my wife and I, where we take them through the constructs of where they're trying to go, what assets they have, practice, other investments, and really take them through where they want to go by what time period. It all comes down to buying back time. It's all about replacing income, whether you're ready to sell soon or you're not going to sell for 5 or 10 more years. But if you have milestone markers to figure out how you can replace your income, even if you're not ready to sell, that's what gives you the certainty to know where you are in that pursuit. Without understanding where you are, it's just an accumulation game. And that's how the financial markets work. Whether you have taxable accounts, you have 401k accounts, it's all based on accumulate, keeping your fingers crossed that when you're ready to harvest that equity or make that money work for you, where do you put it? Your financial advisor doesn't know. Typically, they're going to take you out of what they consider a risky stock market and they want to put you in bonds, right? Or annuities, or whole life insurance. I mean, I'm just not a fan of any of that stuff. I'm not saying you shouldn't have some of that if it makes sense for you, but I've never been a fan of that. So Blueprint Days, we walk through, and what we give our members is a way to reverse engineer and figure out what their timeline is so they know what they've got and they know how to build it and get there faster. That's the takeaways that we do. In Freedom Founders, oh, you know what? I missed something here. Sorry. Back to the capital stack, which is really going back to this slide, equities versus debt. So the capital stack is a financial construct. I don't know why they're skipping through on me. Where you have equities, in this case, in the stack on top and debt at the bottom. So equities, again, that's your growth factor. When growth is in the marketplace, that's where to be. Whether you use debt, leverage, or not, growth is what gives you tax benefits. It gives you value add, all the things we like. But when we're in a market cycle shift, again, what Apollo and Blackstone are saying, they're moving out of equities into debt. Senior debt, mezzanine debt, that's second lien debt, subordinate debt. But that's lower risk on the capital stack. You're not going to get the big high returns that you get with leverage in growth. Typically, I mean, private equity, I mean, their returns are way up. I mean, they're trading on the businesses they buy. They're using arbitrage to a massive degree. In real estate, commercial real estate, 15, 18, 22% with leverage in a good market. We've been seeing a lot of that. No more. Those equities are coming down in value. They're going to come down a lot because there's a lot of short-term financing in place, just like I talked about with the DSOs. There's a lot of short-term financing, variable rate. The headwinds are there. It's going to take that down. Not as much of that in single-family residential because you've got long-term fixed rate for the most part. There's still a lot of people that speculate with short-term rentals and other high leverage speculative that will get in trouble. But both sides, everything equities is going to take a hit to different degrees. Debt is much, much safer. And as Schwartzman said with Blackstone, if you can get 12 to 13% on debt in a market like this, what else is there? Now, there'll be a time to roll back into equities after we see the correction that I believe is coming. It's either in the next 90 days or next 9 weeks or next 9 months. I can't tell you when, but it's coming. So if you go to higher ground now with wherever your capital is, which I would say would be treasuries, short-term treasuries. I've got a tranche in short-term treasuries. Yep, I can get 5.5% there. Basically, no risk. And then still on the debt side, easy to get money from anywhere from really, really liquid at 8.5% all the way up to moderately liquid, a year term at up to 14, 16%. I can do that in the real estate markets. I can't do that, lending money to the bank. I can't do that in treasuries. Yes, is there more risk? Yes, but how do you mitigate risk? Well, you're in the game. You know how to do the due diligence. You've got access points. That's how you get to higher ground. So I would just tell you that wherever you're going to put your capital, if you've got some coming out right now, just be very, very careful with it because you can't afford to take a big hit, 20, 30, 40%, like we've seen in past downturns, and make that up, particularly if you're on the backside of your career. Not a time you're really in more capital preservation. I would look really hard at preservation. If you're younger in life, you've got more time. You can take a little bit more, quote, risk and stay in growth. But right now, there's just not a lot of growth to be had. I think, William, you asked, are we topping out in the markets? Yeah, I say we definitely are topping out. Now, could we see another surge, some crazy surge of 5, 10, 15% before we hit it? Yes. But you can't time that, right? I'd rather go to higher ground sooner than think I can time that tsunami that the Richter is starting to show. It's coming in. I'm gonna play the last minute and I'm gonna run for the hills. I don't think that's a good thing to do. I think you've got to take higher ground sooner. And if there's a final blow off the top, you just got to let it go and realize that you probably saved yourself a big downside risk by not staying in too long in equities. All right, we are going to give you resources. If some of you are interested in finding out more about the resources we have to offer, and again, this is not sales, be glad to let you jump on a discovery call. If you've got a coachable attitude, you don't have to be debt-free, but just well-managed debt, and you've got $1 million worth of capital, you might be a fit for Freedom Founders. But you don't have to be a fit for Freedom Founders to have a discovery call. If you'd like to learn a little bit more about the resources we have, happy to help you. We're here to help. Some of you might be interested in Freedom Founders if you fit some of this criteria. If you want to do that, here's how you can schedule a discovery call. It's not a sales call. It is a discovery call. We don't sell. We invite the right people if it makes sense. And our invitations are always risk-free. If you'd like to do that, again, no obligation. There's the URL, freedomfounders.com/discover. You'll be talking to Alex. I've referred to him already before. Alex he's not mild and meek. No, that's not really Alex. That's Colin McGregor. This is Alex. Alex is not mild and meek, but he's very sharp, very astute, very kind, and has been with me and Freedom Founders for the last 7 going on 8 years. He and his family also follow the constructs of Freedom Founders. And I'm not going to speak for him, but with four young kids, they are moving to their freedom number very, very quickly because of what he's learned and what he's put into action. So that's Alex, great guy to talk to. Again, there's the link if you'd like to schedule a discovery call. But again, we're going to provide anybody resources in some emails coming out. But if you'd like a discovery call, it's easy to do. All right, I told you I'd keep this under an hour. Boy, I did it. I'm under 44 minutes. So now I'm going to kill the screen share because I love to take questions. And Alex, I'm going to pop the chat back open, but if you want to jump in and pick some up that you think might be relevant, I can go back a little bit too and see what we've got so far.
Yes, David, we have a number of great questions here in the chat and more coming in. Maybe we'll just start here at the top from William. And I know you've spoken to this somewhat, David, but he was asking, have we seen the top of the market for private equity?
Yeah, I'd say definitely. I'd say definitely with top of the market. This rise in interest rates takes time to work through the system because realize, again, whether it's commercial real estate or private equity, they're still working off of some amount of the debt that they took on, say 2 years ago at much lower rates. So they still got some of that, but at short term, they have to turn it over. They have to refi it. So as that short-term debt comes due to refi, they have to go from, down at 2%, popping all the way up to 7, 8. In fact, I was reading this in the Wall Street Journal. This is today. Soaring borrowing costs hit riskier companies. They were talking here about Petco. Petco took out a $1.7 billion loan 2 years ago at an interest rate around 3.5%. Today, they're paying almost 9%. So what's that? A 2.5 times? That's huge. What's happening there? They say Petco isn't alone. Many companies borrowed at ultra low rates during the pandemic through so-called leveraged loans, often used to fund private equity buyouts. There it is, folks. Now, I just read to you what Schwartzman and Rowan are doing with Apollo and Blackstone. They're moving away from equities. Yes, we have hit the top. The onslaught is coming. I'm just telling you, it's coming. Mark my words. We'll come back to this date right here, September 28th, sometime in the relatively near future. And you'll remember what I said. We've topped out. So I will definitely tell you to bank on that. Current multiples. All right, I'm just reading down with you, Alex. So current multiples. So remember, it's not about the multiple. Now, multiples are coming down, but remember, it's more about the structure of the transaction. I can give you a price. In other words, in real estate, it's like I'll give you your price if I get to set the terms. That's the way it works. Same thing in DSOs. They can give you some pie in the sky multiple, but what they're going to do is they're going to structure it to put the risk on you by changing the terms of how you get that multiple. So multiples are coming down. The height of multiples in dentistry really was about 3 years ago. They've been coming down. Now you can still find some out there that might. I just talked to a doc the other day. Just joined Freedom Founders. He's got 2 practices and he got a 7.2 multiple. Not bad, not as high as they were, okay? Now, I haven't dug into them with what the structure of that is. That's where the rubber meets the road. What is the structure of that multiple? That's what you've got to look at. So don't let the multiple be your hang up. They'll try to entice you with a higher multiple, but they're going to change how you get it in the terms, and that's where they pull the sleight of hand. Why are DSOs only interested in large practices? Large practices, it's scalability. It's scalability. Larger practice, more scalability. The aggregation model, they've got to have a certain run rate because it's harder to aggregate a lot of smaller elements together, right? The bigger the practice or practices they can aggregate together, the faster they can move. So that's why they want the larger practices with a certain amount of EBITDA. They'll look at other factors too. They don't want to buy a practice even with a strong EBITDA of an older doc. Why? They need you sellers to stay on. That's a big problem they have in the industry right now. You know it. You've dealt with associates, or maybe you've been an associate. The associate turnover is the linchpin. That's the thing that's killing a lot of them because they don't know how to replace or replicate the culture that you built. I know a lot of DSOs and sellers who sold to them in just the last year or so. Again, this is anecdotal. I'm not going to give you names, but they have seen the demise of what they once built. Now, fortunately, these people have gotten most of the bulk of their money out, but they've watched the demise of these practices. We're even seeing some of the DSOs selling off some of the really bad assets, the ones that they just totally blew it. And the practice has just gone downhill. They're selling them off, liquidating them to keep their balance sheet as strong as they can because they can only get refinance money at the higher interest rates if they can even get it. They've got to have a strong balance sheet. And if they've got assets that are not performing, that's no good. So they're getting rid of some of them. I mean, I'm calling it the disintegration of the DSO model. No, they're not all going to fail. Some will make it through. But on the other side of this, for those of you who like to do your own aggregation and build up practices, there's going to be some huge opportunities, as there are going to be in real estate. It's very similar, the same thing. Opportunities will come. You've got to get through the gap and be in the higher ground to have the capital to go to work and take advantage of the opportunities you want. Let's see, Michael, what do you see as threats when current owners hit the 5-year and start to leave? Yeah, how will the DSO be affected, and how will they replace the current owner? Exactly. Just what I just said. You're 100% correct. Whether it's 5 years, 3 years, whatever the contractual earn-out period is, that's where the problem comes in. You're 100% right. The smart ones, I say the smart ones, smart DSOs, I've seen some earnouts going as long as 7 years. I mean, personally, I wouldn't touch it with a 10-foot pole if I'm the seller, but that's what they're trying to do. They need to handcuff the seller in as long as they can. That's critical, because if you don't, what do they got? They've got the same problem that every one of us have had during our time as practice owners when we tried to, quote, plug in an associate. Just plug one in, right? You don't plug in an associate. You're lucky if you plug one in that works. Lucky. You usually got to go round and round and round, and then you finally get a good one. If they're that good, then eventually they want their own practice, right? It's a turnstile, and that's where they're going to have the problems. I totally agree with you, Michael. Let's see, just going down the list, David, I'm seeing a movement toward the development of private DSOs like that of, I won't mention his name. I know the gentleman. Is this a substantially different platform than traditional private equity? Look, I'm not going to demean a person because I like this person as a person. The model itself is bad. The person's not bad. The model's bad. Okay, let me just say that. I'm not going to go into greater detail. I would just stay far, far away from that model. So it's got a lot of problems in it. I can say for a fact. Assume sold means partial sale too. Okay. All right. Okay. I see what you're saying in the questions we ask. Yes, I would say a partial sale, a buyout to a sellout. I don't mean sell out. You sell out. You sell to a DSO on a buyout. Yes, I would consider that a sale. Yes, sir. All right. So there's the link to Discovery Call. Very good, Alex. Let's see, Brian. If you were looking to sell to a DSO in the near future, in general, would you advocate for immediate sale before the crash, or waiting 2 or 3 years to sell? Well, I think we're on top of a crash right now. That's the problem. Now, are you seeing it left and right everywhere? No, but we're seeing enough holes right now to let me know that we are on the front end of it. So I would only sell right now if I was getting enough front-end capital that I would be happy with it, where there's no clawbacks. And if we got into this thing and the culture changed and they changed everything, because look, everything changes when money's on the line. When money's free and easy, then everybody's happy, right? Same thing in real estate. The syndicators that have had this great run over the last number of years, they charge a lot of fees. They really put all the risk on the equity investors. They really do. I'm not a fan of how they do it, but as long as the market kept going up, everything worked, unless they were corrupt, right? But as long as they weren't corrupt, the market took care of it. Same thing with DSOs. The market is taking care of it, even if they. That's why a lot of them will say, "Hey, we're going to partner up with you. We'll let you just run your practice the way you want to run it." I know they talk about being invisible, and many of them have been. I know. I know. I hear the stories. I talk to people. There are some that have been very good about saying, "Hey, just do your thing. We're just back here. If we can give some admin help, we can give you some leverage with supplies and lab work, etc." Perfect, great. But when the rubber meets the road for anybody and finances get tight, to survive, you start cutting. You start cutting. And that's when some of the ones who have been hands off are going to have to come in and they're going to start cutting. And that's not going to be a happy day for you or your team, your staff, the culture that you built, because they have all this leverage. And now the leverage is overcoming the profit margins and they've got to come back in and start slashing. That's when the great culture and the great people that you know on the front end can change. Again, I'm not saying this everybody, but this is the danger that you're going to run into. All the happy stories in the past, you've got to take those with a grain of salt. Let's see. Dr. Brady Frank was run out of money. Yeah, well, you can, that's what I'd say. I'm not going to say anything. You do your own due diligence. You can do Google searches. Thank you for that. I didn't have to say it. Excellent. Yeah, well, thank you. I appreciate that. I just try to give you my very biased, but non-agenda advice, because that's just what I like to do if I can help. Any thoughts on joining a brand new DSO with opportunity for founder shares? I'm assuming this would be higher risk than, yeah. Look, gang, typically on a risk scale, anybody who's new to the game, in general, is going to be higher risk. We've seen that, again, same thing, seen it in real estate. Everybody and their mother and uncle and aunt, got into real estate in the last 3 years. Like short-term rentals was the big one, right? Everybody's like short-term rentals. And then there's a lot of people that came out of the woodwork and all of a sudden they're capital raisers for syndications. They know nothing about it, but they are able to go into niches like dentistry, accredited investors, and they team up with a, quote, GP who, again, how much experience do they have? Again, the market's been taking care of everybody, and you go to town. So I think I have a lot of caution there. Again, you can do a deep dive. You can go get somebody to help you look at their financials and see. But taking shares in the parent company, I just think you got a lot of risk there. Are you going to get it? There's no guarantees at all. So just be very, very careful what you put on the line when you make these. If you do make these deals. When you say run for higher ground, do we get out of equities completely, or do we stop dumping new money into it? Young doc, mid-30s. Okay, that's very helpful because yes, your age and time frame definitely makes a difference. The advice I would give to you would be different for someone who's 65 for sure. So I think yes, when you're in their 30s, if you want to play a little bit more risk in equities. Now I can't tell you what in stock market equities to be in. That's just not my game. So I won't even pretend. But if you're good at that, you think you're pretty good, or you got someone that works with, and you want to keep some there in your 30s, look, I don't have a problem. If I'm in my 60s, like I am, I don't play that game. Well, I've never played the game at all. Okay, that's just me. Again, I'm just telling you my bias. But yes, I think I would probably, whatever your allocations are, in general, I would start reducing equity exposure. Whatever that means for you at your age, I would reduce equity exposure. I think you all are going to look back on this date. And if you do some of the things I'm talking to you about, don't have to do everything. I'm not telling you what to do. You're going to be glad you did some things. Whatever you decide to do, you'll be glad. I can just almost bet the farm. I don't have a farm, but I almost bet my farm if I had one. Good question. If you had built a small group with 5 to 10 locations, what would you do over the next 18 to 24 to 36 months? Hold and operate, or yes, I would hold and operate. Absolutely, I would hold and operate. If I've gone to that much work, and it's it still takes work, right? I mean, hopefully if you're in that position, you've got systems, protocols, you've got good team culture, and you are really elevated yourself to practically CEO, and you're not in the chair. If that's where you are, yes, I would operate. I'd get through this next 24, 36 months. We don't know exactly what it is, and wait. I do think in time, the Federal Reserve is going to have to come to the rescue and drop interest rates and go back to QE. But I think they're not going to do it. This is just my opinion, until they see a 30, 40% market correction. They're going to want to see real pain, and then they'll come to the rescue. So you don't want to be in the middle of that. So you want to wait till that happens, and then on the other side, when they start pumping things back up again, because again, my long game feeling is we're going to see a lot of inflation, going forward, but not right now in this period of deflationary correction. This is a period you got to be careful. So don't let the exuberance of the past market drive your thinking today. Yes, think in terms of getting through a gap. 24, 36 months might be a good period to look at. So that's exactly what I would do. What model is next? How can we sell to associates at similar values? Well, probably not going to sell associates at similar values. Values are a basis of supply, demand, and capital availability and interest rates. And we really, in the past few years, have had kind of like the perfect storm for that in all equities. That perfect storm, we'll get some of those back. We're not going to get them all back. So you're probably not going to be able to sell at what the multiples, even with the buyout, have been in the last few years. I don't think that's going to come back. I see stagnation, stagflation, low growth going forward for quite a while. But again, we'll have to see what the Fed does. If they drop rates and some crazy money comes back into the marketplace, that might be a place where, again, you could pop and exit. I would think more in terms of going for the long haul and looking at how you do set up potential equity partnerships. If you really want to stop the associate turnstile, then yes, developing a protocol for bringing in the right associate to partner, and it takes work. You all know that, but I think that's the model I'd work on. I'm going to put my emphasis there, rather than trying to think the DSO is going to come in and take care of all this, and we'll take care of associates, and we'll find those for you, and we'll take care of your staff and everything they promised to do. Yeah, they can do that to a point, but then again, when margins get tight, trust me, their game's going to change, and that's not going to be pretty. Let's see, Zach, I'm considering buying another practice to merge with my own. There's an option to also purchase the commercial real estate that he has with 4 established tenants. Got it. Would it be a better idea to hold off on the building purchase to allow for the coming real estate correction? Yeah, what I would try to do in this case is get an option. At least a first right of refusal. That would be minimum. But if you can get an option, and depends on your negotiating skills and what the owner of the building wants. But if you can get an option for some formulaic strike price where you could set it, and if it goes down, which I think the markets will correct, then you can always come back and renegotiate. So he might even like going with an option to purchase. Option doesn't obligate you to buy it all, but it prevents him from selling to somebody else. He's got to come back through you, right? If you got an option. So try to get an option. If you can't, at least get a first right of refusal. But yes, I would wait and let the market shift, and ideally be able to buy with hopefully lower interest rates, in who knows, 24, 36 months. Try to do that. But I always try to lock up the real estate. If I'm leasing it and I want that real estate, I try to lock it up with something like an option or a first right of refusal. Lease with an option in this case is what you'd be looking at. So there's a lot that goes into that, but there's good negotiators in the space. In fact, I've got resources. I'll pull some out and hand those off to Alex. If there's somebody you'd like to talk to that can help you negotiate that kind of thing, that would be worth your while to do that before you just jump in and either buy the building now or just don't buy it at all, but have some stake in the building if you can get it. It can be done for sure. Let's see. I'm OMFS startup from scratch. Awesome. New Jersey. Should I worry about the sudden rise of DSOs in New Jersey? I don't know if I'd worry about the sudden rise of any DSOs. Like I said, I think we've seen a topping in the market. I think there's going to be some disintegration of some. So I wouldn't worry about it. I'd play my strong suit right now, which is operating as you're operating. Keep your keep your margins and keep your overhead as reasonably low as you can to get through this next period, which I think we're going to see a recession and things that will make it a little more difficult to run a business. Just keep your head down, stay solid, and what happens around you, it's going to be no consequence to you. That's my short advice. Thanks, Gabe. Clean up a lot of misinformation. Sure, absolutely. I appreciate you being here. Let's see, Nick, how easy is it to leave the practice after you sell to the DSO? Let's say year down the line, things are not going well. So that's why you want to really look at the contract that you negotiate, or your broker or representative negotiates. You just if you have the right to leave and just without any additional clawbacks, and of course if you leave, then you're leaving probably the recaps on the back end, you're leaving those. So yeah, if it really is down and dirty and just like, I can't stand this, all right, if I got enough money on the front end, like I said, be happy with that. And if things just go downhill and there's no additional clawbacks if you leave early, you're good. But that's all going to be in the contract, right? So just make sure you negotiate that hard if that's what you want, and you want to have that right. If you don't like how things are going, you just take what you gave me, DSO, I'm out. That's the way I would try to run it, right? Everything's negotiable. Everything's negotiable. So just don't give up your rights on any of this. Have good representation. Let's see. Expensive dental equipment. Okay, I'm not sure what the question is. Maybe I'm missing it. Okay.
David, I think the question is, there's another portion of it that was here earlier. Will expensive dental equipment like a cone beam, for example, be better bought after the market correction? Well, yeah, in general, I think this goes for any, well, let's just say this. Yeah, in general, when you go through a recession in general, where businesses aren't expanding, they're actually laying off, right? Reducing staff, reducing footprint if they can. Well, look what's happening with like Meta, Facebook and Amazon. I mean, they're giving up office space, distribution center. They're giving that stuff up right now. Why? They can't use it. So all that stuff, it could be rented or resold at a cheaper price. Same thing, I think, with dental equipment. When times are good and there's lots of money out there, what does everybody do? They jack their prices up. What happened during supply chain issues, in COVID? I mean, all your supplies went up. I mean, everything went up because you couldn't get anything, right? So they jack it up. Now, when there's excess inventory and there's not many people buying it, yeah, I think you're going to get, generally speaking, better prices on whatever you have to buy. That's in general. Usually bigger ticket items, right? Like that. So yeah, I think that's reasonable to expect if it doesn't make sense for you that you need to buy one right now. But again, remember, return on your investment has to be utility. And if there's a piece of technology, cone beam, that in your hands right now in your practice could give you a big lift, again, you've got to weigh that out, right? So sometimes if it makes a big difference for me, I just want to get it, whatever it is, and I'll pay whatever it is because I think I can make the ROI on it. But if I'm not sure, yeah, then I might sit back and wait a little bit. So yeah, Proctor, thank you. All right, I think we cover everything pretty much. That was awesome, man. Thank you all very much. We did all that in just a little over an hour, and I really appreciate the engagement. I hope this was helpful to you all. Again, happy to help provide resources to any of the stuff we talked about tonight. And seriously, no sales, but if you'd like a discovery call, you got to see Alex right here. He's a good guy. He doesn't break arms. He could, but he doesn't. So I'll let you know. All right. Very good. Yep. Thanks, Adam. Thanks, Nick. I appreciate you all. Hey, let us know what else you'd like me to bring to the table. Because again, I have lots of resources, lots of contacts in both real estate and dentistry. And I do a lot of podcasts. You can catch me on my podcast. You can catch me on YouTube. But I always love to get feedback. So honest feedback of what you'd like to hear more from. I just like to create and try to provide resources and the best kind of guidance I can. That's all I got for y'all tonight. So hope we get to see each other again soon, but feedback's always welcome. Have a great evening, and maybe we get a chance to meet before too long. All right. Take care. Good night, everybody.